Right, welcome to part 2 of lecture 9 FMGT 3224. We're in the middle of looking at whether the Lovell company should drop its digital watch segment, and the answer can be obtained by preparing comparative income statements. Okay, so let's do that. If we keep them, we already have this information, we know what the deal is. And automatically we can drop down to contribution margin. If we drop it, the contribution margin is chucked out of the way. So no contribution margin for us. Okay, now general factory overhead, we were already told that that is not going to go away. So that's one cost that we will not avoid if we get rid of this division. We can get rid of the line manager, so that cost will disappear. The amortization of this depreciation. So here's the thing: as soon as we get rid of or scrap the equipment associated with the digital watch division, well, we're going to record this as a as a loss on disposal anyway. So whether it's an amortization expense over 5 years or a loss on disposal immediately, it's still a $50,000 expense, and therefore in either case it's 50 grand. It doesn't differ between the two alternatives, and so it is not relevant. Advertising we avoid, rent on the factory space we avoid, although even there sometimes, if you're going to pay the rent anyway and you've got nothing else to put in there, often this is not an avoidable cost, although here we're treating it as though it is. And then we were told this general factory, or sorry, the general administration expense is not avoidable. So here's the deal: keep the watch, lose $100,000. Sorry, keep the digital watch segment, lose $100,000. Get rid of the digital watch segment, lose $140,000. So in actual fact, you're better off keeping the digital watch because the contribution margin that it generates covers some common costs that would otherwise go uncovered. The general factory overhead, you've got the equipment expense in there, and the general administration expenses. So you are much better off to keep the digital watch division. The whole $40,000 better off. So now we can look at, instead of doing comparative income statements, we can look at the contribution margin approach. The rule here is they should get rid of the segment only if the profit from getting rid of it would increase. Fair enough. So what does that look like? Well, contribution margin is gone. We know that, right? So we are out of pocket that $300,000, but we save the salary of the line manager, we save the advertising that we're not having to spend, and we save the rent on the factory space that we're not paying. That adds up to $260,000. It's still not enough. We're still $40,000 worse off, and so you'll notice, obviously, we've come to the same conclusion as we did here, $40,000 worse off by getting rid of it. It's just this was quicker, simpler, and more elegant. So this would be the contribution margin approach to solving this particular problem. So what's the moral of this story? Well, again, as I mentioned earlier, it has to do with the way that common fixed costs get allocated to the product lines. By common costs, we mean things like head office costs or rent for a big facility that has multiple product lines in it or business units in it and so on. The rent cost isn't going to disappear. It's just going to get shared out among the other units that are still there. And so as long as this segment is still contributing towards these common fixed costs, usually you're better off keeping it. So let's try brief exercise 9-3 and have a crack at that, see if the concept has worked for you. All right, so bed and bath, the retailing company has two departments, hardware and linens. Recent monthly income statement for the company is as follows. A study indicates that $340,000 worth of the fixed expenses currently being charged to linen are sunk costs or allocated costs that will continue, even if the linens department is dropped. In addition, the elimination of the linens department will result in a 10% decrease in the sales of the hardware department. Okay. If the linens department is dropped, what will be the effect on the net operating income of the company as a whole? All right, so we could do this by doing a keep and drop comparative income statement, But let's do the contribution margin approach here. We will have, first off, the lost contribution margin from the linens. And right now the linens contribute 600,000, so we are going to lose $600,000. But it also says that if we drop the linens, we're going to lose 10% of the sales in the hardware department as well. So that is going to be a 10% reduction in the contribution margin of the hardware department. So we also have a lost contribution margin for hardware. Notice that we look at the contribution margin, not the sales, because if you don't sell something, you also won't have its the variable cost that goes along with it, right? So 10% of the full up contribution margin is 2.1 million. 10% of that is $210,000. Okay, so we're already staring at a loss in contribution margin of $810,000. So if this thing is going to be worthwhile, it's going to have to save us more than $810,000 in our overall costs. And so we look at the fixed expenses, and the fixed expenses right now are $800,000. So even if we were able to avoid all $800,000, save the $800,000, we'd still be worse off doing this job. But we found out that we can't save all of the fixed costs. Only some of them are going to be avoidable. Avoidable fixed costs are the full 800,000 less this 340 that we're told are not avoidable, right? So it turns out that we are only going to save $460,000 worth of fixed costs, and as a consequence, the total lost profit, net loss / worse off by $350,000 if we drop the linens. So keep. Right, so we want to keep the linens department. And that concludes this brief exercise. Okay, so next we're going to take a look at a somewhat related decision as keep or drop, and that is make or buy. Do you make something or do you buy it? Our example here is the Essex Company. So if we right now we manufacture a part and the cost is direct materials, labor, overhead, amortization, and so on. So it costs us $30 per unit. Now, if we buy, what happens? Again, the question comes down to how many of these costs are avoidable. If we stop making it and begin buying it, we're certainly going to avoid the materials, the labor, and the variable overhead. The depreciation, probably not going to avoid that. Supervisor's salary, we may or may not. Depends on whether or not the supervisor is solely dedicated to this product, in which case we can get rid of him or her. But if they supervise a bunch of things, they may not be willing to go down to an 80% workload kind of thing. They may want to stay full-time, and so on. And then this old bugbear of general factory overhead, that's a bit of a giveaway that something might not be kosher there. So total amount of general factory overhead which is allocated on the basis of direct labor hours will be unaffected by this decision. Okay, so whether we make or buy, that overhead's not going away. It's still there. And $30 cost per unit is based on 20,000 parts produced each year. Okay, so that's a allocated fixed cost. Outside suppliers offered to provide the 20,000 parts at a cost of $25 per part. So again, as we stare at this, we look at the numbers and we go, oh, hold on, 25 bucks is cheaper than 30 bucks. Maybe we should do this. Not so fast, right? Let's take another look. So cost per unit, make or buy. Buy is going to be 500,000, right? $25. The make is 340. But now we have to kind of go through this and see which one actually makes, which of these costs makes sense to, or is actually avoidable. So, depreciation of equipment. We've just said the special equipment has no resale value. It's a sunk cost. So the amortization cost on it is going to be incurred whether we use it to make the product or whether it sits idle in a corner. And we're still going to record the amortization on it. Now, again, general factory overhead. We've just discovered that that's not avoidable. Okay, so it's not going to be, we're not going to be able to get rid of it. It's still going to be a cost to us, and therefore it is not, whether we make or buy, it's a cost that's going to be in as part of our decision regardless. We can leave it out because it's not relevant for our decision now. So then the question is, should we make or buy the part? And by now I think the obvious answer is we should continue to make, right? Because it only costs us $340,000. It will cost us more to buy. Why? Because this cost and this cost are not relevant to the decision. They're still going to be incurred whether we make it or buy it. Another way to look at this would be, $3 times the 20,000 units, $60,000 here, and $60,000 here, and $10 times the 20,000 units, $200,000 here, and $200,000 here. It would change these totals, but not the difference of them, right? There's $160,000 difference. We're $160,000 better off making than we are buying. And that, at the end of the day, is the final answer. So let's take a look now at brief exercise 9-4 and have a crack at a make or buy problem of your own. All right. So for many years, future companies purchased the starters that installs in standard line of farm tractors due to a reduction in output. Some of its products, companies got some idle capacity. That's important, right? And the reason is, look, if you're at full capacity, now you have to not make something else in order to make instead of buy, right? So you now then have to factor in the opportunity cost of making. But if you have idle capacity, then the opportunity cost is zero. Okay, so we can buy them for $12.60 per unit. Let's figure out what it's actually going to cost us to make them. We know we've got to hire a supervisor. We've got idle tools and machinery, no new equipment. The rent charge is based on space utilized in the plant. Okay, total rent on the plant is $148,000 per period. Depreciation, okay. All right. Well, let's take a look at this. So we've got the alternative to make or buy. First cost is direct materials. If we make, we're told it's $465. If we buy, it's the full cost here, right? $12.60. Direct labor is $405. Supervision, we were told we've got to hire someone. Super for $2.25. Depreciation. Now we've just finished saying that depreciation is due to obsolescence rather than wear and tear. In other words, that depreciation is going to be incurred whether we use the equipment or not, and therefore we'll write down depreciation, but it is not a relevant cost in this decision. Variable manufacturing overhead, absolutely, because it's variable. It's going to be a factor in making it, right? The more we make, the more costs we'll have. Therefore, it needs to be included in the decision. And rent, is that relevant or not? Well, it says the rent charge above is based on space utilized in the plant. It doesn't say that they would have another use for that space. So it looks to me like the rent is going to be paid whether we make or buy, and therefore it's not a relevant cost to this decision. And therefore then, if we go and add up each of the alternatives, it turns out that rather than costing the $13.80, it will cost us only $11.85 to make, as opposed to the $12.60 to buy, and therefore we should make and stop buying. And that concludes the exercise, and we'll continue in part 3 of the lecture.